We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Jaime Carrasco, Portfolio Manager at Canaccord Genuity. Thanks for joining me today, Jaime.
Thanks for having me back, Tom. Good chatting.
Excellent to speak to you as always. So I recently saw that you tweeted that your recommendation is to hashtag Hedge Accordingly, which is something that you and I kind of came up with a long time ago now. But your strategy of hedging accordingly comprises 40% gold, 40% silver, and 20% blockchain. So what role does blockchain play in your portfolio? And let's just kind of hear your elevator pitch about it, because I heard it was quite interesting.
Well, that's a great question, because blockchain in my portfolio took a position. I took my first position in 2018 before Bitcoin went up to 20,000. And I did say to clients, let's take a position in this new technology. I think it's going to be quite disruptive and quite revolutionary because of what it does. And it's that added ledger component. So the way that I like to pitch the portfolio going forward today is that now that we are at 20% blockchain, I have it there because blockchain to me is already building a decentralized future. People, the whole confusion is with Bitcoin as opposed to trying to understand the blockchain. And we'll talk about that in a second. The other component of the portfolio is that 80% that's designed or to benefit from the destruction of the past monetary system. Because if you look at the fundamental forces of money printing, the way that central bank monetization, the fiat system, which have never lasted over time, well, the net effects of everything that is happening is unraveling as we speak. And sooner or later, they're going to lose control because you can't just print money. You can't create that facade. And as I've always said, since we've been doing these conversations back in 2015, I've always said that inflation was going to build and the processes of destruction, well, they're not going to pay back the debts. All they can do is devalue the debts. And that's why now we're hearing the conversation about a reset. So really, if you really think about it, what we're going through right now is the transition of the monetary system. That process is beginning. The real question is going to be, what shape is it going to take at the end of the day? Because I find that China has been very quiet since the G7 meeting. They haven't said much, nor reply as to what came out of the G7. And really, if you look at it, the G7 are muted without China in the mix. On the other side, blockchain now, we continue to build a decentralized future, and that is scaring central bankers. You look at the discussion today in terms of, we're gonna establish a Fed coin, right? Well, if you really think about it, Bitcoin and Ethereum are already developing something that they can't control. And what they want is centralization. They want control of the system. So what I think is important is that you have a lot of people already figuring out. One of the things, look at that debate that took place with Michael Saylor and Frank Giustra. I listened to it 3 times because I found it fascinating. And what really struck me was the fact that at the core of the debate was, how am I going to make money on it? Instead of discussing, what does it do? What does the technology do? And how is it going to change us? If you start to analyze it from that perspective, you start to see, wait a minute, this is completely different. Because what it is doing is decentralizing. It's that ledger effect. The fact that if you look at the internet, where it's come from and what it is today and what it's achieved, it's just data. That's it. The blockchain by default is data with an assigned value. And because of that assigned value, it has that extra component that means that in 30 years from now, it's going to be worth way more than just data, right? And so you have to understand how that data is changing everything we do, because everything is being ledgered. Now, if you think on the essence of the banking system, what is it? Well, they ledger our money and charge us a fee so that they can guarantee that our money is ours as we're paying our bills and things. Well, what if all of a sudden you have an electronic solution that you don't have to ledger your money to a bank? Because to pay my hydro bill, well, I can send it myself and guarantee that it's my money because of the ledgering effect. Well, I think it's going to do to the banking system what email did to the post office. right? So that's why I look forward. One of the things as we're going through this transition is that things are going to get negative. Look at the whole discussion of inflation. Well, I can assure you that having grown up in Latin America and having talked to my family constantly after we left for Canada, Chile didn't feel the effects of inflation that we felt in Canada. They were at the outer edge where you were really getting hit with the storm. So one of the important things about inflation is that we learned that it was never transitory, but it's a net effect of just the devaluation of money. You know, everybody thinks that prices are going higher. No, what is actually happening is that the money you're spending with is devaluing, and that is happening globally. Well, when you start to look at it from that perspective, you start to understand that I love how central bankers always, it's transitory. Well, we're going to unpeg gold in 75 and it's going to be temporary. Well, it's going to be 50 years, August 14th, 2021, and we're still temporarily waiting for gold to come back. What it really allowed was for this mess to be created, for this debt bubble to grow. You know what? We've gone from 4 trillion balance sheet at the beginning of the COVID crisis to 8 trillion now. Well, what it's really showing is they can't take money out of the system. The only way forward is to continue to inflate. So do understand that the inflation, I see the inflation of the money supply as the bilge pumps in the Titanic. What it means is that once the process of decline begins, all you can do is print, kind of like trying to push the water out. But in this case, it's debt. The system's overwhelmed with debt. And that's what the repo market is signaling. So when I look at the world going forward, what I'm trying to do is concentrate on the positives. There are positive effects of inflation. There are positives coming out of blockchain. It's rebuilding a new world. So how do we structure how do I structure my portfolio advice to my clients and new people coming in terms of how to position themselves to benefit from what is happening? There's always two sides to every trade. I tend to look at where am I going to make money before everybody gets in. As for my portfolio and how I'm positioning, exactly that. Have a participation in the blockchain because that's going to build a future, but also benefit from positioning yourself to protect your assets from the inflationary result of central bank policy as it all unwinds within the monetary system.
So, Jaime, something that you brought up was that these cryptocurrency or these blockchain technologies are threats to these central banks. So, what, let's say, concerns do you have in regards to them seeing that as a credible threat and, let's say, blocking access to them?
None. Because that assumes that they can't control the unwinding of the system and that they can keep the Titanic up as it starts to sink. My point is that we've gone way too far. The system, we know that the system, and they know that the system is imploding. That's why they're calling for some kind of a reset as per the SDRs coming out of the IMF and Basel, right? So they're actually telling me that we know things are done. Now they're not going to tell us because they don't want to rush for the doors. You know, think about it. Why is gold right now trading at 1,800 or whatever price it is? It should be so much higher. But because of the lack of regulation, and when we have this Basel III that's really signaling the Basel III change that just kicked in, well, what's it doing? Banks now have to, and the American banks they don't kick in until later in the year. But the European banks, as of June 30th, they have to account for what is paper contracts and what is physical gold contracts. Something that they haven't had to do since 1975. So by default, forget about what they're telling you. Look at what they're doing. What are they doing? Within the European banking system, they are allocating who's got physical, who's got paper. Why is that? Because central banks have never stuck to proper accounting like everybody else has to do. And so their leases, their paper contracts are still considered an asset. So it's a complete facade within them that, yeah, they talk a different language, but people don't understand what they're saying to you. But on an accounting basis, they have to now figure out who's got what, who's got the physical gold, right? And so that's why the Basel III changes are important. Now, I don't know how much of a pullback or how much of a rebound we're going to see in gold because of that. I'm not going to speculate there. All I'm going on about to answer your question is understanding that the ship is sinking and that their ability to bring in their Fed coins is going to be how quickly before people realize that, man, they're the ones that created the problem and they're the ones that are sinking it. right? So what I think, I go back to the last time that we did a fiat system. That was in 1770, right? The second thing, once that fiat system finished, the apex, the Fed at the time was the French central bank. Well, what did the French do once they figured it out? First, they cut off the king's hand. Next, they went and cut the central banker's head off, and then they burned the printing presses in France. But what was the net result of that unwinding? It was the creation of the republics. We come out of that in a beautiful way because we had to rebuild the world. If we were sitting here in 1760 and we're having a discussion, you and I, and I'm telling you, you know what, maybe in 1770, you're going to have a vote. You would have been, oh, what are you talking about? How's the king going to feel about that? Well, think about it. After 1770, the king's gone. The whole political system of royalty, serfs versus the kings, was gone. What we create is a brand new society based on each having equal vote. And what comes out of that, a brand new monetary system called the gold standard. Who benefited from that? The two guys that set it up, Isaac Newton and John Locke. John Locke. I always confuse Law with Locke. John Law was the Irish, the Scot that actually, he was the Greenspan of the time that allowed the French to just borrow. But anyways, the net consequence of that fiat system was the creation of a brand new world. So that's what I'm looking at is if this is as bad as it is, we're going to have to rebuild anew. Well, if we're rebuilding, hey, let's use blockchain. We don't need the banks. We can fully recreate a brand new social structure on a global basis now because we are interconnected. And that's why when I look at blockchain, and forget about Bitcoin, forget about the Bitcoin thing, because that's only 19 million units and we've already issued 21 million, right? Look at the blockchain itself, and that blockchain is going to build on Ethereum. Well, that's going to allow us to completely decentralize. So I think what we're going to end up with is going back to local communities, and that's why I like living in a small community where you know your people and you're trading among each other using an electronic system that is already working. Well, the problem is that everybody's still in the Titanic. So to them, this little lifeboat doesn't look that appealing right now. They haven't figured out that there aren't enough lifeboats. But when the ship sinks, well, and we have to get in the lifeboats, it's going to look very appealing. But then again, once we're in the lifeboats and those are left are going to say, well, how do we rebuild? Well, what other tools we have? Blockchain's there. And that's why, to me, it's fascinating what is happening. And I'd rather concentrate on the positives than the negatives, right? If you're concentrating on the negatives, you're thinking, oh, how do I survive the Titanic? And how do, instead of, okay, this thing's over, how do we rebuild? Which is really how I'm thinking and how I'm positioning clients going forward.
So in a way, the blockchain technologies are their smallest problem that they have on their plate.
It is. The problem is that people still don't, there's too much noise. There's too much noise. I keep listening to the noise. Transitory inflation. What is that? Well, yes, inflation is transitory because what happens with an inflationary cycle is that you get this inflationary spike, then things come down. Oh, so it's over. No, the problem is that it never comes down as much as it went up. So it always a little bit less and then back up further higher, right? So you get these cycles that are going to continually repeat. If you really think about the bond market is, yes, it's signaling that is transitory. But here's the facade. How much of that was because some of that $8 trillion in Fed balance sheet has gone to buy up the bond market? Now I have a question. If the banking system is so great that it got a flying balance sheet, it got an A report card in the last Fed assessment of the banking, well, why do they need $1 trillion every night of funding, right? So yeah, things are great, but we still need all this money. Now we're arguing about giving $250 billion to the U.S. economy into infrastructure. Meanwhile, we're spending $1 trillion a night keeping this one sector going. Right. So those are the inconsistencies that I see. And to me, that spells trouble. And it's good trouble because what it means is that real assets are going to have to go up a lot to fully reflect the unwinding of money. So we're back to gold and silver. Copper still signaling that, steel prices, food prices, right? And now energy. Look at energy prices. It's the perfect storm. If energy gets to 100, forget about transitory inflation, right? I think anybody that doesn't understand what happened in the 70s, well, better get a history book or just start watching some Barney Miller shows, right? Because to fully understand how inflation affected North America because of the inflationary spike of energy.
So Jaime, as you're talking about this real, let's say, currency reset, and you're saying that the blockchain will be a big part of it, do you think that gold will play a role in that as well?
Definitely. Let's talk about that and look at it from an energy content. Okay, so you have this whole discussion that green energy, that Bitcoin and the blockchain takes too much energy. Well, tell you what, both extracting gold out of the ground and extracting and hashing Bitcoin or any blockchain coin requires energy. They both require energy. However, there's a big difference. If energy stops, your Bitcoin's gone. If for some reason in my neighborhood right now we have a blackout for a week and we're working in a blockchain environment, that is gone. It's not there. Well, my gold and silver is still here and I'm going to be able to trade them. That's why blockchain is not gold. There's another issue. We are only on day one of the creation of the blockchain. So think about the internet circa 1995. Well, Bitcoin, we've already issued. So there was this big noise about China stopping production of the hashing of Bitcoin. Well, who really cares when 19 million units are already in circulation with only 2 million units left for the remainder of time because of the inflationary effect of the hashing? Well, the bulk of them are already circulating. Now, if we look at the blockchain as I look at it, which is similar to the Roman roads, because I compare each one of the coins being created, be it whatever it is, I look at them as the cobblestone that created the Roman roads. Well, not only are we only 500 miles out of Rome, but out of that 500 miles, there's already the 19 million Bitcoins that are set up. What says why do people believe that somebody else can come up with Bitcoin 2.0? So exactly the same thing, another network along the road that's going to have another 19 million. You see, that's why you can't do that with gold. You're not going to come up with another gold. The other argument that I hear is that Bitcoin could become the next monetary system. No way. There's no way that 19 million units, you can have a global monetary system based on that. There're just not enough units. Right. So whichever way you look at it and you start to and you bother to try to understand money as it is, you understand that Bitcoin is not gold and it could never be the basis of a monetary system. What it is electronic currency, an electronic ledger. And that's the problem. What they're messing around with is the fact that we have a paper ledger right now that became a fiat system that is controlled by these guys, the central bankers that can print it willy-nilly. Well, the bulk of the population is just waking up. Now, what's important is that we have that Rubicon. We don't need everybody to wake up. What you need is 10% of the population alone. I know that we have crossed that Rubicon for a number of reasons. Since the last interview we did, my phone's still ringing. People are finding that interview and they're coming to me and they're saying, you know what? I like what you're saying about inflation, but I've gone to my advisor at the big firm and they don't want to talk about gold, right? So what you have is a complete dichotomy of where the train is going, where the party's still there in the Titanic and everybody, I want to stay in the party. I don't need to look at the lifeboats. Everything's great in here. Versus clients themselves approaching those advisors and saying, you know what, my parents came from Chile, you know, and they talk about inflation and they're very concerned. So it rings a bell. Can you tell me more? Well, no, the party's going on, not to worry. Well, those people are coming to find me. And why is that important? Because remember that analogy I said that you're in a theater, full house, opening night, Star Wars, and smoke starts coming up. It won't take more than 7% of the people to have that rush. I'm in the 1% that already figured it out since 2015. I've been saying, look, these policies are going to get there. You know, this is cumulative. It's not going to end. What we have today is that we have more than 7% of the population already waking up. And that's why I think gold will play out very differently. That's why I think everything is changing. The pressures to take out physical. Look at what's happening with the silver squeeze movement. These people are taking physical out, and it's never coming back. So it is dislocating. There is that transition already occurring where there is awareness, and awareness is key. It's that red pill moment. And I think we've crossed the social Rubicon. Definitely in Latin America we have, because all the clients I was talking to at Scotiabank way back when, well, that phone is ringing again.
So as we're talking about all of these, let's say, epic bubbles, Jaime, where do you see opportunity lies in this environment right now, if this is the case that everything is in a bubble?
Well, I think we don't know when the bubble ends. The markets could go exponential from here, which is okay. The money devaluation is the key, is how money is going to devalue. So you got to look at what are the net effects of it all. Back in, one of the beauties that I see right now is that, gold and silver haven't been allowed to run up yet. Very quickly, let me do a segue. Why? Because if gold was trading anywhere where it should be, and where should it be? Much higher than it is. All I know is that Terry Duffy, the head of the COMEX, in 2017 said, stop dismissing what's going on around us, because gold right now should be $7,000 to $8,000. Well, it should be higher than that. Let's say it was at 4,000 or 3,000. Would people be trusting what the central banks are saying? No, they wouldn't, right? So to a big extent, what has been done to the price of gold is to shut off that alarm that would throw off bells in people's head that, hey, our policies aren't working. And so what is good is the fact that gold and silver, the lifeboats, are still very cheap. But what's happening is that advisors at the big firms, not only have they not been trained on thinking about it, but they're sitting on what they've developed is this full diversified model built with ETFs based on futures, which are very risky, in order to give you participation in these markets that continue to go up. Well, the problem is that the ice is getting thinner and thinner, because it's not the asset problem. The problem is the underlying currency under which that portfolio is written that is going down. It's funny, I was reviewing the other portfolio that I manage, the equity income portfolio, which is for my parents, right? And I was reviewing it with a brand new client, and I was saying, well, the problem with every equity income portfolio today is that it's designed to pay you cash flow, but there is no hedging for the devaluation of that very set cash flow. All those dividends that are coming into you, well, they're devaluing in purchasing power as well. That's why you have to build the internal hedge within that very same portfolio. What do we have? Those portfolios right now are running higher, higher, higher. So people are saying, oh, I'm great because the portfolio is running higher, without realizing two things: that the value of the portfolio, if the market crashes, will go down. But the purchasing power of the portfolio is devaluing, and that's a stealthy valuation that nobody sees, right? And so that's the key to hedge, because you want to maximize the cash flow that's coming back to you. And so, every way I look at it, people now are coming to me and saying, wait a minute, I get that. I get that because my parents came from some other country. They migrated for political reasons, for economic reasons, where those very same factors were playing. So there is an awakening. There is a light has come on within the advisor community that is lacking, right? And that's why it's so good for me. It's a benefit to be at an independent firm. Not only that allows me to position my clients in the way they should be positioned, because there's no way that a 30% weighting in precious metals in a conservative blue chip portfolio is even going to be allowed at a big firm in Canada or anywhere, right? But at an independent firm, you can, right? And I think that's important.
So, Jaime, you're talking about the underlying currency losing value, and you watch the US dollar very closely. So since the last FOMC meeting a couple weeks back, it has gained some strength. So where do you see this strength coming from?
Well, strength at 92, I don't think that's strength.
Comparative strength.
Comparative strengths, yeah, comparative strengths, but that is a gasp in a dying man. Mm-hmm. Bottom line is the dollar has to be killed. The dollar, we all know that the dollar as a current currency reserve can't continue to work. China doesn't want it, right? Let's look at the picture from the China's eyes. China has to start trading in their own currency in the same way that Roosevelt takes over the power in 1933. The best thing for Roosevelt in 33 at the midst of that depression was to take over the purchasing power of the global currency, the new dollar backed by gold created in 33. China's biggest problem is internal inflation. Inflation has always been what does it for China. Mao's regime came down because of that. Mao comes to be because of that, right? Look at the issues with food in the 80s and 90s, right? So inflation is the number one thing that China will have to control. And in order to do that, they have to control the currency reserve. Now, we know that through the IMF, they already said that they would participate in the SDR, the special drawing rights, if it was backed by something tangible. We know that China's sitting on 20,000 tons of gold because they leased it from us and we sent it over. But the central banks are still calling those leases assets. So people haven't figured out that the gold's already in China. Why do we know it's there? Because it was smelted. It was smelted at the 3 smelting points around the world. Switzerland, the main smelting point because it's monetary refinery, Dubai, and the Perth Mint. And as they were smelting it, the Chinese weren't working a metric system. So they were going from pound bars to kilo bars. They knew whose gold was being smelted. So we know that gold has already ended up there. So it's up to them to call the next currency reserve. How will they do it? Well, I think the will it be backed by gold or backed by a basket? All I know is that gold has to be in the mix because it's the only thing that we all have in quantities to reset a monetary system. That's been the process for 4,000 years. And yeah, maybe it's different this time, as bankers like to say, but I doubt it because or else they would be selling it. By the way, the impendium, the gold, in gold we trust is out.
Yeah.
I would highly recommend anybody that is interested in the topic, that is the best compendium of the gold industry around. And look at the charts. Central banks have been buying since 2008. Right? They continue to buy as much as they're telling you, oh, don't touch it. You know, it's different this time, not to worry, right? No, gold is still part of their monetary system. And while that's there, it's going to be part of the transition of whatever they're going to do.
So, Jaime, is that central bank gold that's been sent to China and melted, or let's say sent?
Of course,
to the
it
smelters?
is. It's the gold that was sitting either in New York or London. And that gold was shipped over to first Switzerland or Perth, where it was smelted, and then into China. On the ledger side, on the Western side, what did they see? Oh, no, our gold is here because we've leased it out. But that lease is still considered an asset. So one of the problems that we have is who's got what? We don't know. So I think that's part of Basel III. Makes sense to me. Well, if we're going to reset the system, we might as well first figure out who's got what. How much gold did you have, Tom? So from now on, Tom, you know, if you have any paper contracts, you got to count them as paper contracts. And if you have physical gold, count it as an asset, as a tier 1 asset. And your paper contracts, well, we're going to keep them as a tier 3 asset. So again, they're communicating between themselves what I want to hear, but they don't want to tell people. But people aren't listening to what they're saying among themselves. I am, right?
Yeah, we need to watch what they're doing rather than listen to them.
Exactly. Right? And how to position yourself. And I think it's very positive, right? Because again, from an inflationary cycle, all real assets are going to go in price, and they're already going in price. I'm actually quite happy that I'm taking in new accounts and I'm able to position into gold and silver producers, which, man, if you follow history, those things are a gift, and the cash flow they're going to pump out is going to be unbelievable. And we're talking about producers, not explorers. I've been having a lot of success with explorers, but that's with accounts that have already built solid position in the producers, right? Where what do you want the producers? Well, at $1,800 gold, with somebody producing $600 at $600 Canadian, which there are many producers in that picture. Well, think about what their earnings are going to do when we get to $3,000, $4,000, $5,000 gold, right? The dividends are going to just escalate, reserves on the ground, everything, right? So that's why I always advise build a solid position in the producers, especially for older clients that can't afford the risk. And by the way, those stocks, like we're talking about Franco-Nevada, within the compliance of every department at every big bank, that's an aggressive investment, even though it has less volatility than Bank of Nova Scotia or any of the bank stocks. The beta of those is lower, but they're considered aggressive because they produce gold and silver, which is very aggressive, right? So yeah, you gotta read through how the game has been set up. in order to position yourself, but you got to be clear about it in terms of where it's going.
Jaime, I'd like to go back to talking about inflation with you. So last year we had basically zero inflation print numbers, and it looks comparatively extremely high this year, just looking at that year over year comparison like that. The Fed comes out and says this is a transitory phenomenon, yet the Bank of America comes out recently as well and says that we're going to see 4 years of high inflation. So how do you square these two, and who do we believe?
I believe myself, actually. I just know that throughout history. So let's look at that 5% inflation right now, right? Which, could come down throughout the year. But first of all, do understand that 5% today is not 5% in the 1980s because of all the hedonic adjustments, right? So they're really lying to you. It's not really 5. It's much greater because, first of all, we're not going to count food and we're not going to count energy because you don't use it. The people don't use those two, so we're not going to count them. Oh, wait a minute. They do, but then we're not going to count steak. We're going to count this soy beef that they're pitching us, right? Because that's cheaper. So they do these hedonic adjustments and they continue to lower the number to support their narrative. Well, my narrative is, well, you know what? When I'm looking at society here in Collingwood, and there's a lot of wealthy people, but there's a lot of, there's the support staff working at the hotels and that. All I know is that it's harder and harder to make things go through, right? If you look at the cost of food, you look at the cost of everything. Well, it's much greater than they say. So the problem is, first of all, is that they're fudging the numbers. So it's not real. So if it is 5, it's greater. Well, the problem here is that inflation is always an exponential event. So it was 0 as calculated by them 2 years ago. And now we're sitting at 5. Well, I can assure you that it's going to get to 10. Because let's think about this. Rates are at 0.
Even by their metrics.
Even by their metrics. And let's go through the numbers. Rates are at 0. Inflation's at 5. Their number. So we have negative rate of almost 5%, which means that money is devaluing by that rate. Well, they're not going to raise rates for another 2 years. So the question I have for anybody thinking, how high will inflation be by the end of the year? Never mind within the next 2 years. So they're going to have to raise rates. They're going to have to raise rates for another reason, because the system, the market is going to say, forget that. It's going to go the other way, and they're going to lose control of the system. That's why they need to reset. If they lose control of the system, it's chaos for them. And then we end up with the guillotine, just like we did in France in the 1770s, because people have figured it out. People are figuring it out. There's going to be anger. But on an inflationary basis, right, well, I think what they want is a controlled demolition. And that's why the reset is needed. But when it comes to inflation, you better think for yourself and just look at your bill at the end of the month. It's not going as far. It isn't going as far as it did last year or the year before. Well, think about it. Your cash flow, your pension coming in from the Canada Pension Plan, your pension coming in from your old pension fund, your RSP cash flows. Well, they've stayed steady while the costs are rising. Well, just wait till they start to do that, right? So I'm hedging for when they start the decline in the cash flow, and that's why I think it's time to. I think people have to think outside the box, seek help from people that understand what inflation is and how to set up. Because again, there's a lot of benefit to be had. Silver at $27 is a gift, right? Well, I can assure you that eventually those silver assets and those gold assets are going to offer way more protection from inflation, and they're going to do what they've done for 4,000 years. Why? Because you can produce it. Right, it's that constance that they've had throughout history, throughout millennia, that it's the one thing we all can guarantee that it's theirs. My Canadian dollar versus my silver coin, what's going to be better? Because that Canadian coin or that paper is paper, but the coin itself is not even silver anymore; it's tin. Right, and eventually that tin's going to be worth more than the nominal value, because tin is even going up. Right. So if every way you look at it, if you really start looking underneath the rocks, you start to see what's really going on.
Mm-hmm. And to your point earlier, inflation goes up, but it never comes back down by the same amount, right?
Exactly. And what's neat is that when I look at the portfolios and the last quarter, the drawdown are getting lower and lower all the time. What it signals is that money, good money, smart money is coming into the companies that I own because I've made it a point of stock picking. One of the things that advisors today don't do is know how to pick stocks. They've been trained to think in terms of these asset allocation models. So just buy the CTF here, buy that ETF there, and they're given these formulas from the firm. Okay, build that model and give that to your clients. Don't question anything. Never mind, okay, what's the difference between an Agnico Eagle versus an exploration stock, right? And how to pick that stock, how to build a portfolio, things that I was taught at Merrill Lynch when I started in the business. That isn't even taught anymore because they don't want you picking stocks because it creates a compliance problem, right? So again, they want these strict models that are designed for the past. Well, if you think about it, maybe the past is about to change and you should be taking a different stance, which is funny because when I started in the business, that's exactly why Merrill Lynch was teaching their brokers how to pick stocks, because we had gone through the nifty 50s of the 50s and 60s, inflation hits, and then you got to get back into a stock picking mode. So by the time I started in the business, before I went to become a repo trader, well, they were back into stock picking, and that's why Merrill Lynch, that was the focus. How to pick stocks so that you can develop these very close, very controlled portfolios for your clients, because those were the best at going through inflation. So back to the inflationary cycle, which was coming to its end when I started in the business.
So Jaime, can you give us a little bit of your thoughts towards how you go about picking these stocks, what's important to you, and what you're really looking for to make something attractive to you?
Okay, within the, and we're talking about the producers, not the how to pick a pipeline, utilities, and all the big blue chips, right? Those are easy to pick. If the funds own them, you know that. When it comes to the producers, I really look at 4 criteria: solid reserves on the ground, low cost of production, good management, and in geopolitically safe areas, right? So right now I'm stuck in a situation that I'm looking how Mexico will develop. So I haven't been adding anything to Mexico because, I'm a little bit concerned about the geopolitics in Mexico and how it's turning. AMLO is a different government. We're still trying to prove how things are going to sort out. It's a bit of a populist, unionist. So how will that play out with the old Mexican system? On the other hand, I'm looking at what's happening in Africa, right? At first, I was a little bit concerned about Fortuna Silver, which is one of my companies, bought a gold company in Cote d'Ivoire. At first, I was like, oh, I don't understand Africa. So the first thing that I had to do is reanalyze the geopolitical risk of the country that they were in. And I've realized, as Latin America is starting to go downhill a bit from the populist wave, Africa is starting to come out because Africa has gone through a lot of development. So again, here's a shift where I'm comfortable with the geopolitics there. So I was quite happy with the portfolio and I'm very happy with the purchase. But, you have Argentina that it's actually coming along much better than other places, right? So that is a fluid picture, but geopolitics is key. And there's where you have to understand a little bit of the political system in these countries, do some homework and figure it out. Research on the ground, I love them because at some point we're going to use blockchain to monetize every one of them. So think about a company like Agnico Eagle. Right now, those 20 million ounces or more that they have on the ground are not really being monetized or certain asset value. But think about the day that blockchain, this future, is going to monetize every ounce on the ground, take it out of the banking system, out of the bullion bank system, and we're going to be able to function from Earth to the end, right through on a blockchain technology. So again, I can see what I'm looking for is if I'm going to put my positive thinking cap, how are we changing in relation to the technologies that are coming to us to set up the new world? And I think it's amazing because within that equation, central banks are not even part of my narrative, right? I'm looking forward to a time when people are going to realize that they put us in a massive pickle. How mad are they going to be? I don't know. I've already adapted to that. I don't get mad. I just think positive, look for the future, and advise my clients, those that want to follow me, and they are. One of the things that's amazing is the discussions that I'm having with clients, because as I was saying, the drawdown we had in this last quarter wasn't bad. It was actually, we held on very well at the very same time that, I think the blockchain has already hit that bottom. And so we're starting to see those upsides starting to build. At least we're going sideways. And I think gold and silver, once they start the next run up, is going to be amazing.
So Jaime, we were talking about let's say the geopolitical landscape here, and something that you and I have spoken about before is that is the risk in Chile. And of course, growing up there, you're well aware of the politics and everything around it. So they've officially started to write a new constitution as of July 4th. So what are your thoughts on the path the country will set going forward? And what are the most important pieces that you think they need to include?
That's a really good question. Because Chile is about to rewrite its constitution. Now, it's a constitution that Pinochet set up. Okay. Now, I have a really hard. My relationship with Chile is how to put it. Is interesting because my grandfather supported Pinochet, my mother's father. My father, though, he's a communist, and he said, I don't want my kids growing up in a fascist regime. But thanks to my grandfather, my mother said, well, we're not going to the Soviet Union or Cuba. So we ended up in Canada. And then along the way, I started working in Chile again. So I've watched it change. Over the years. What's interesting about the Constitution that's going to be rewritten is that in the last election, the right didn't get any votes. So this constitution is going to be rewritten by more the youth and the left, right? Now, I think it's going to be a very interesting experiment because it's going to take Chile, something that is at the core of Chile. And I said this to my father, and he kind of, last time, in 2014, I ended up as a director for Scotiabank, really managing the relationship between the bank, Canada and Chile, managing family offices, the pension. And I was back really working full time in Chile and getting to know, going back regularly. And what I did notice about Chile is how much it's grown, right? And it has grown much because of Pinochet. What Pinochet did is that he just cleared out the debt. Right. So Chile went through a massive economic contraction because Pinochet did what needed to be done in terms of getting the debt cleared. And that's what today makes Chile one of the best countries in the world, because debt per capita is at $2,500. So I came back from Chile and I was talking to my father. And I said, Dad, I think history is going to remember Pinochet as the most Chilean of all Chileans. And in normal fashion, he said, what the blip are you talking about now? Because I'm the capitalist and he's the communist. And I said, well, if you think about it, and we measure Pinochet by the human rights abuses, he gets a 100 because he was the bad guy of Latin America in the 80s. But if you measure him by what he's achieved for the country economically, he also gets a 100. And then I said to him, and after all, what is Chile's motto? Chile's motto is by reason or force. Right? So if we can't do it one way, we're going to do it the other way. And he did it the other way. And he stopped and he said, I'm going to have to think about that. So let's go back to Chile today and the Chile of my cousins, of their children, right, that went through the whole thing. They're looking at Chile in terms of what it also achieved, right? So yeah, how the Constitution reshapes Chile and how it comes out, I think it's also going to be in relation to what has been achieved throughout all of these years. And I don't think it's going to be as black and white as people believe, because the history of Chile has always dealt with adversity, right? Chile has always, it's a tough country. It wasn't like going into Peru for the Spaniards that came, the Araucanos, the natives of Chile fought, and the Spanish fought. It wasn't complete compliance like the Incas. So Chile has always been a country of adversity. We took the north of Peru through a fight, through a battle, right? So I think that by reason or force is part of Chile's psyche. So I will be watching how this constitution evolves very carefully, because it'll be a really good litmus test for the rest of Latin America. But against that, there is a recognition, like if you look at the copper industry today, copper industry is owned by Codelco, right, which is a nationally owned. So a lot of people work within the mining. So that is different than when Allende was there, who Allende nationalizes, because at that point, the whole copper industry was mostly privately owned, right? So a lot of things have changed. And I think it's going to it'll change in relation to the reality of what Chile has become. So yeah, there is, and also one more thing that has to be said about Chile, that from an political education perspective, they're way more savvy than in North America, where really there is this lack of full understanding of the political system, right? Where if you look at the U.S., it's black and white, Democrats or Republicans. I've often said that to me, it's like a zebra. The political system is just a zebra, and the Democrats and the Republicans are just two stripes. Canada, the same thing. We are a little bit more ambivalent because we have it so good, which is not the case in Chile, where you need to work hard. You need to really make it. So I think it's a great example for the whole world, because some of the challenges that they're looking at, it's all global challenges, right? But I'm not negative. I don't think it's going to be. I don't think we're going to get full, anything like expropriation of the mining or anything like that. I think it's going to be more of a democratic reality, more as per the way Chile has developed because of Pinochet and Allende, both of them, right? Which really takes it to where we are today.
Excellent, Jaime. Do you have anything else you'd like to touch on before we wrap up here?
No, all I would like to say is that, I do think that going forward, things are not going to get from an inflationary perspective. That's a positive if you want to look at the positive, but it could be a very big negative. But start positioning to benefit from inflation. That's the one thing that I would say. And we've been talking about inflation for a long time. It's funny because last March of 2020, it's when Russell Napier, and we discussed it in an interview, Russell Napier had come out and said, I'm switching to an inflationary stance. At that point, everybody was, oh, no way. Well, here we are now, and inflation is creeping in. And the problem with inflation is, you really believe that central banks have control? Great. Continue to trust that. But if for some reason you're thinking that maybe they don't know what they're doing, well, I suggest hedge accordingly and start taking a different stance, just in case inflation's not transitory, right? Take a hedge, and by the way, asset allocation is the key to our portfolio. What does that mean? That within an asset allocation model, back to Ibbotson, who did all this work in the 70s and 80s, 7% is the bare minimum that every portfolio should have in gold. Most portfolios had nothing. 7%. I'm currently sitting at 30% in my most conservative portfolios in producers, not explorers. The explorers are a different animal. That's more of full speculation, luck of the drill. But within the producers, they're ridiculously cheap. So all I can tell you, for anybody that's looking to start hedging themselves while there's still time, the producers are ridiculously cheap at these current valuations in relation to where they're going. Even at $1,700 or $1,600 gold, which we're not, and I don't think we're going to get there, they're very cheap because they're trading at about $1,000 gold, I figure right now, $1,000 to $1,100 gold, right? Agnico below 80 is a gift.
Excellent, Jaime. Of course, you post a lot on Twitter and on LinkedIn. Your Twitter is at IJ Carrasco with 2 R's, and Jaime Carrasco on LinkedIn. Jaime, thanks so much for your time today.
Thank you.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.